This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Daniel back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Daniel's picture saying, looking for the downloads.
Well, Patrick, the S&P started to turn lower last week, but it only got down to 62.80 or so before they bought the dip, and, well, already we're 100 points higher, give or take, at recording time. What comes next for the S&P?
Well, Eric, the jobs numbers last week finally triggered a market correction. We were 300 S&P points above the 50-day moving average, a typical overbought state that has mean reversion. Now, we weren't bearish thinking that there was a massive decline, but these kind of 5% market corrections back toward the 50-day moving average are commonplace throughout the course of a year as these bull trends happen. So we got this peak to trough correction of about 3.5% in 2 days, and the market is recovering here. Now, this is actually going to be a very important moment because if we are transitioning from the bull phase into much more of a distribution phase, which is associated with topping formations and trade ranges, which is an example of what essentially happened starting in November of last year into February of this year. That was like a 3-4 month trade range with a ceiling on the market. Will we see that develop? We are now slowly approaching the period where a lot of these vol targeting funds are completing their buying. We saw some spikes in volatility. The VIX got up to about the 21 level, and most systematic strategies have already done most of their buying. So what will be the next incremental gain? Well, we now have the odds of a recession increasing, the likelihood the Fed is now going to be cutting 3 times this year appearing in the market. So a lot of these headwinds could make the market heavy. Now, typically, if we see the resistance start to come in around that 6,500 level on the S&P, and this becomes a point of resistance for the markets throughout the month of August, then we can start talking about what in September, October could, from a seasonality perspective, bring about a deeper or more meaningful market correction. But right now, that information is all going to be revealed in how the market behaves up along these highs. All right, Eric, let's move on to the U.S. dollar.
Well, Patrick, our regular listeners know we've been waiting for and talking about the formative counter-trend rally in the dollar index. It failed. It was rejected right at round number resistance at 100 even on the Dixie. Already at recording time, we're back down to trading on a high 97 handle. So all indications are that the counter-trend rally that you and I both thought might have legs to 102 or 104 may have already failed at 100 even. This says to me that the structural bear trend is probably back on, meaning more downside for the dollar and probably upside for gold as well.
Well, Eric, on page 3, we have that chart of the dollar. And what I want to really highlight was that we had a legitimate attempt for the U.S. dollar to rally. We basically spent a better part of 6 months in a downtrend, trading decisively below the 50-day moving average. And the dollar stabilized throughout the month of June, July. And we saw a basing, and we saw the first attempt to squeeze above the 50-day moving average, breaking to a higher high. These things typically would trigger a feedback mechanism of a buying and a short squeeze. And it really did feel like it was underway until that very negative jobs number hammered the dollar. I mean, now at this stage, it's clear that the Fed is going to have to ease a little bit more than expected. That has to start being baked into the cake. And the dollar has weakened on that. The interesting part here is that the dollar has now almost wiped out all of its bullish advance that it had in the prior week. And so we're in a situation where, was this one big fake out breakout? And is the prevailing US dollar downtrend that's been in place all year going to maintain and continue to trend lower? The first sign will definitely be a breakdown to the 97 level on the Dixie. But then really what we want to see is the characteristic of failed rallies, quick distribution into any strength, the type of price action that is saying that the situation is deteriorating for a further breakdown. Another leg down in the dollar index, if that becomes the unfolding reality, does measure all the way down to the 95 level on the downside of the Dixie. All right, Eric, let's talk about crude oil.
Patrick, Wednesday afternoon's dip was a perfect test of the contract 100-day moving average at 63.63 on the September WTI delivery contract. I used that weakness to add to my time spread trade in both size and duration of the spread. But as far as directional trades, I think the Trump administration still intends and probably has the political support and friends in high places and OPEC places that they need in order to get lower oil prices. I don't think they're going to flip the curve into contango. And I think that if we do get those prices, it's really going to be an even better opportunity on this time spread trade that I've been discussing. So I'll continue to cover that in future weeks. But for me, no directional trade at this point.
Yeah, similar to the dollar, the moment that jobs numbers came out, the dollar took it on the chin. The interesting part here is that we've now come right to the bottom of the trade range that was essentially established throughout June and July. We obviously had that Middle Eastern confrontation spike in crude oil. And since then, this is $64, $65 level has been the base. And the question here is that with the recession odds now increasing, clearly the question is that will there be less oil demand? And does that create a situation where oil can actually break down this key support line? My entire thesis up until that jobs number was that we're going to find a new elevated higher level of crude oil in a trade range, but with a deterioration to the bottom end of this range, we are at the cliff's edge to find out if the support lines don't hold right at these lows. The technical measured move is for a double bottom retest of that $55, $56 area. And while that wasn't the scenario I was looking for, if that support line breaks, it's going to become the most probable outcome that we're going to be able to see in what's next. Overall, I think that these are still great levels to own oil in the longer term, but on the short term, this may not be where the trade is. All right, Eric, let's get your thoughts here on gold.
Well, Patrick, the gigantic contract roll premium basically saved the day for the continuation chart. The contract chart really wasn't looking good. We had a firm technical level at 3,300. We were not holding that level as we recorded last week's podcast, but the contract roll got us back well above that key level. So now the continuation chart actually looks pretty strong, even though the contract chart for the expiring August contract didn't look so strong as the continuation chart looks. Ultimately, I expect that we're going to break above this level, and then there's going to be another pause at 35.08 or so, which is the all-time high resistance, and then finally a breakout from that previous all-time high to a new target somewhere in the 37.50 to 39.50 range. But there's still plenty of room for another test of the 33.50, that's 3350, lower trend line support on this triangle pattern that we have in the daily chart before this is over. And frankly, the high and wavering slow stochastics on that daily chart are suggesting that a head fake lower might actually be needed in order to shake off those overbought technicals before this market is ready to break higher. So it looks like there maybe is another swing lower on gold before we eventually break upside out of this triangle, but at least it's looking like we're above all those short-term moving averages. The more likely breakout direction is upside as opposed to downside as it was starting to look last week when we recorded the show. And then finally, the 100-day moving average on gold is rising through 3285, 3285. So if we had a deeper bearish pullback here, a test down to 3285, just below that 3300 level, again to test the 100-day moving average before finally breaking higher, that would certainly make sense as well. So 3285 would probably be, if we saw another counter trend move in the dollar or some other policy move from President Trump that was short-term gold bearish, that would, I would say, be another buy the dip opportunity level, 3285.
Well, gold just proved to be in one big trade range. It traded right to the bottom end of the June low. And once that dollar broke down, shot right back up to its highs. The more interesting thing is to seeing how the gold miners, which had a good earnings season, broke out to fresh new 52-week highs and were almost like leading the way for gold futures. Is that an indication that that breakout to 52-week highs is imminent? It's the thing to watch, because if gold does manage to make that technical breakout and hold it, the measured moves are all the way to 3,800 to 4,000 on the upside. It'll be very interesting to see whether or not this is the time frame from which that bull breakout will engage. We are right there up along those highs, and so this is probably not going to take more than a week or two to resolve itself as to whether that big breakout is underway. All right, Eric, what are your thoughts here on uranium?
Well, Patrick, sure enough, my jumping the gun last week and also invoking superstition and joking about it on the air, saying I knew that by going ahead and buying the last of my position, I would miss the buyable dip. Sure enough, that's exactly what happened. I brought on the buyable dip. But I think it's really interesting that, number one, that buyable dip was only about a 4 or 5% buyable dip. Maybe it was 6 or 7. I'm not sure. It had fully retraced by recording time, and I won't be surprised if we're looking at new cycle highs on the URA ETF over $42 by the time our listeners hear this podcast. So a deeper correction is still possible at this point. The big upside catalysts are not really expected until late Q3 and into Q4. But overall, my take is that it's game on for this bull market. I'm glad that I have my full target position on. I don't mind if I have to ride out some more volatility from here. If we really get a deep dip, I'll probably buy some more and increase the size of my already overweight position.
Well, Eric, for me, it continues to be two different stories between the equities and the spot prices of uranium. And so just starting off, I have that chart on page 6 of the Sprott Physical Uranium Trust. And to me, technically, this is still actually very bullish. And more importantly, a very early stages bullish. We had a 15-month bear market decline that wiped out close to 50% of the value of that Sprott Physical Uranium Trust. And since then, we have now technically broken out of that bear market decline. And so far, the dip has actually been very well defended, right in the retracement zones, and is actually technically trying to turn up. This is a classic buy zone for an upside breakout on physical uranium. Now, on the equity side, though, uranium equities had just an extraordinary bull run, and we're much overdue for some sort of a reversion or correction. We're going to see how deep that correction goes, but if uranium itself starts to bull higher on a turn, then that correction will almost certainly just manifest itself as a key buy on dip opportunity to get some exposure on the dips.
Patrick, I can't decide how to interpret the technical indications or the importance of the technicals as they pertain to this copper market, so I am seeking your advice as the technician in the house on how to interpret this. On one hand, it is crystal clear that the whole reason for all these big moves on copper, both up and down, $1.50, just unprecedented moves, it's not because of any economic fundamental anything. It's because the President of the United States decided not to worry about the collateral damage that he was causing by negotiating in a style of bluffing where he pretended to be imposing a tariff that he really had no intention of imposing. That whipsawed the market up and down a few times, and it's pretty clear that copper negotiation is over. It's behind us. We should pretty much write that off and say it's done. Okay, it's so tempting to just say, okay, it's an incredible buy-the-tip opportunity here because it's a super strategic long-term resource that just got whipsawed around so badly and beaten up so badly by the president's, I would say, somewhat reckless negotiating style of foreign diplomacy that the technical chart just got artificially beaten up. But one of the rules of technical analysis is you're supposed to just say the chart is the chart. You don't try to get fancy and write off what the chart is telling you. And this chart looks to me like a nuclear bomb just went off. There's nothing about it that's bullish. So, Patrick, I don't know how to reconcile my temptation to buy this dip in size because, frankly, it feels to me like a fundamental bargain here. I really think copper is a very, very strategic a commodity, unless you think that we're starting to plunge into a global recession, which I do not think we're about to plunge into. I just don't see how you don't want to be long copper here. On the other hand, this chart is telling me nuclear Armageddon. How do I interpret it? What should I make of this?
Well, Eric, first of all, technically, it's actually a very hard chart to read because when you have a tariff-driven gap of that kind of magnitude, both higher and lower, it's hard to see actually where the flows and trends really are. The only thing that is legitimate at this point is support resistance lines. And with the fact that we gap down into the low $4 range, we have a major $4 support line that was established in 2024, the lows both in late July and the lows as well through November and December. And so at this stage, it's very likely copper is going to hold those lows on any downside. So the asymmetry of the opportunity exists that you're essentially buying support lines, anticipating that a move in or a bounce in copper here could work its way back towards $5 on the upside. Nonetheless, it is certainly a reasonable proposition, but you really do at this point have to technically be leaning on that major support line.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, Eric, I want to touch on these yields. And what we can see is that the 10-year yield decisively broke down on that jobs number. It's clear that there's an increased odds of some sort of recession based upon the revisions. And so this type of a breakdown means that the pressure for higher yields has now dissipated. The question, though, is that will we see 10-year yields get back to levels where they were last year, where we were trading down around the 360 level on the downside? At this moment, there is definitely a breakdown in these yields. We'll see whether or not they sustain down here below this 430 area, 435. And if they do, definitely vulnerability down to 4% or lower is entirely on the table. Moving on, what I wanted to just show on page 9 is how dramatic of a pivot there was on the probability of a September rate cut. When we were talking about this last week before the jobs numbers, there was better odds than not, actually, that they were not going to move in September. Literally within 1 week, the odds of a September cut has now jumped to 93%. And so we have a clear weakening of the numbers and data to the point that the Fed is going to have to start to ease. And so the bigger question also there is that will that result in some sort of economic slowdown? Because the Fed has historically kept conditions always too tight, too long, and inevitably spurred economic weakness cycle. And are we going to see this scenario where, in fact, some sort of a recession has emerged and the Fed will be late to the game, proving that there was some form of a policy error in them waiting this long to start to act. Now, one of the interesting ways to play that is looking at the 3-month SOFR futures out to December 2026. Now, these basically priced in 25 basis points almost instantaneously on last Friday. But if in fact there is going to be some sort of more prolonged or deeper economic weakness, the question is that will the Fed rate cuts be deeper, especially if there's potentially a more dovish Fed chair put in the middle of next year. And so with this scenario, the question becomes is this a trade where we could see the SOFR futures trade up to the 98 level, which would essentially be implying rate cuts that could be as low as 2%. And this may be a really interesting trade to continue to watch to see if the market is going to be pricing in a much more dovish Fed next year.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.